market. But let's kick it off with the first market conversation of the day. Ed Yardeni, president at Yardeni Research, is with us. Mr. Yardeni, good morning. Happy New Year. Season's greetings to you. Hopefully, it's going to be a very positive 24 for you, for us, for all of our viewers as well. And that's my first question, that we're starting off looking at a lot of positives, and we were just discussing this, the possibility of a soft landing in the U.S., rate cuts and whatnot. Do you think it can really be such a good year for the broader economy as well as for stock markets?
I think the economic outlook for the U.S. economy is still quite good. We had better than expected economic growth in 2023. I think everybody's now recognizing that maybe we're not going to have a recession after all. I think the consumer is going to continue to spend. We've got some still strong capital spending because of onshoring. The housing market is likely to start to recover with lower interest rates. So the short answer is, yeah, I think we are going to see a solid growth rate in the U.S. economy. It might be better than expected if productivity continues to make a comeback, as it seemed to be doing in the second and third quarters. Globally, things still look pretty weak. China's Purchasing Managers Index came out on the weak side. Europe still in a shallow recession and will probably recover later in the year. But on the other hand, countries like an important country like India in the emerging market areas doing very well.
Ed, just to take forward the conversation that we had last week about U.S. rate cuts, the market is pricing or hoping or expecting for about 4 to 5 rate cuts. If the U.S. economy is indeed so solid, there is no need to aggressively cut rates.
No, you're right.
And your forecast was, I think, for 2 rate cuts in 2024.
Yeah.
So will the markets, investors be disappointed by fewer rate cuts? Can that play a bit of a spoil sport?
Well, there could be some correction if and when the market starts to conclude that the Fed isn't going to be quite as easy as has been discounted recently. And I won't be surprised if Fed officials really come out talking quite hawkish, trying to convince people not to overreact here and anticipate too much of an easing move. But on the other hand, if it's only going to be 2, maybe 3 rate cuts next year, it'll be because the economy is doing well, with inflation down closer to where the Fed wants it to be. And so the Fed may conclude that the economy is resilient enough that keeping interest rates just somewhat lower is the right thing to do. I think they're still going to regret having been late to deal with inflation at the beginning of 2022. And I think they're going to, this time around, be a little bit more cautious about getting the markets overexcited about how low interest rates are going to go, fearing that easing financial conditions might revive inflation.
Hi, Ed. Good morning. First of all, a very, very happy New Year to you as well as your entire team, and wishing you all the best in 2024 as well. But given the kind of rally we have seen, Ed, in the last couple of months or so, what's your approach to global equities on the whole? You know, we've had a very, very sharp rally, both the US markets as well as the Indian markets. So in terms of fresh allocation, what would the strategy be at this juncture, you know, between global equity markets as well as across asset classes?
Well, I think what we're seeing is that global investors are becoming a little less focused on what I call the mega cap 8 stocks in the US, the big technology companies. Some people leave out Netflix and call them the Magnificent Seven. But I think more money is starting to head out to other parts of the US economy and the global economy. We're certainly seeing in the United States a broadening of the stock market to small and mid-cap companies. So that's a very healthy development, reflecting the fact that people are less concerned about a recession and believe that interest rates are going to come down somewhat. And then, of course, people diversify on a global basis. And if it looks as though the U.S. economy is going to hang in there pretty well, Europe might have some sort of recovery, and maybe the Chinese government will come out with some sort of stimulus package. The rest of the world will look pretty good. And so we could see European stocks continuing to do better. India's done remarkably well and could very well continue to do so. I still prefer in emerging markets investing in India over China because I think we're still going to see a continuation of capital moving out of China because of geopolitical tensions with China over Taiwan. and because of their restrictive policies on the domestic side.
Okay, well, that sounds good to us. We aren't complaining there, Mr. Yardeni. Finally, apart from geopolitics, and you briefly mentioned that, but apart from geopolitics and, God forbid, any skirmishes, wars, etc., are there any other risks that we should take on board?
Well, at this point, I think I would prefer not to look at other risks so much as the geopolitics. I think at this point, the geopolitics is the major risk, but even maybe some domestic political issues. The U.S. has gotten more partisan. The Democrats and Republicans don't talk to each other and kind of view each other as enemies in some cases. I do worry about some violence occurring as a result of that. The wave of illegal immigration into Europe and into the United States is something that could create some issues. But at this point, I think the most obvious risks are in the geopolitical realm, particularly in the continued Russian aggression against Ukraine, and of course the Gaza war.
Ed, we'll leave the conversation here for now. Thank you very much for joining in. Wish you a happy, healthy, and a wealthy new year. Thank you very much.